be able to go live. Okay. This mic is okay. Thank you guys for tuning into today's webinar. We will be doing our final webinar today in partnership with Scope Markets Kenya. And we welcome you to Learn, Trade and Profit. We shall be reviewing the takeaway lessons that we've learned so far from January to September, from all our guest contributors as well as the STL team. And on my team, we have Samson and Gilbert. And so we shall begin with the first webinar that we did with Tom Beso. He was speaking to us about the beauty of automated trading, and the lesson that we picked for us is that a system is just a system, and you should have very simple and clear-cut rules on your trading, whether it's automated or not. And so that was the lesson, the biggest lesson that we learned so far, and maybe you can chip in on that.
Yeah, for Tom Beso, the thing that I like about automated traders is that they tend to be real about it. You know, they'll tell you that it's not something that you can rely on 100%. So you will still need to monitor what it's doing. You'll still need to do back tests because the market keeps on changing from time to time. So even some of the advantages that you're saying, because I'm looking at a clip here, where he was saying some of the advantages for automation is that you can leverage your time. So that means you can be able to do other things whilst your system is there working for you. But again, it doesn't mean that now it's 100% that you don't need to monitor what it's doing at all. You still need to be there to monitor once in a while, but at least it can free up your time to do other things. So that's just one of the lessons from Tom Beso.
On a personal level, but I'd like to ask you how effective is an automated system in replacing actual trading money? What do you think? What are your thoughts on that?
For me, I can say based off of the systems that I've interacted with, it can't replace your trading 100%. So it's not going to replace your trading 100%, but it becomes more efficient, especially when managing risk. I find that with an automated system, I'm able to manage risks better than when I'm manually trading. Because when you're manually trading, at times there can be some noise that's coming in from the market that makes you, second guess some of your positions. But in an automated system, it's either it was programmed to be in the market up and until it hits this stop loss or your take profit, or there's no changing. It doesn't change its mind, so it sticks to the plan. So I would say that when it comes to risk management, definitely having an automated system is an added advantage, but it doesn't replace the entire trading.
I think that's an interesting point because the automated trading systems, the best applications, in my opinion, is when you're using them for peripheral functions. Because timing the market is a really specialized skill. So it requires a human interaction to do that. So I think in most cases, an automated system will be very effective when you're trying to do peripheral functions like exiting trades and managing your account balance and all that. Sure.
And something else we can also add to that, it doesn't mean that if you're using an automated system, that's the end of it. You still have to keep tracking on the progress. So the human element is not completely dead. Yeah.
Correct.
So I think we can go to the next one.
Yes.
The next one we did with Stephen Goldstein. And yeah.
Yes.
Yeah. And it was about the stories we tell ourselves and how they limit our potential as traders. It was more about trading psychology. He's a performance coach. And so I think the lesson here is about what you tell your mind, and it affects your performance as a trader. And also that also ties in with risk and risk management as well. So you can add on to that.
Yes. it seems more and more, actually, with the people that we interact, it becomes evidently clear that trading psychology seems to be the key thing when it comes to distinguishing success in the market. It's not really even about your strategy, because you can have a winning strategy, like with one of our guests that we'll talk about later, where he said, that you can actually have a strategy that everyone is following, but people are not getting the same results. There are people who are losing, there are people who are making money, there are people who are break even, that are break even. So your mindset is very important. And the things that you tell yourself, if you're poisoning your mind with doubt, and this could be coming from something else. And we tend to see things that are affecting your life outside of the market tend to trickle into the market. So if you're poisoning your mind with thoughts that, oh, I can't be successful, or I can't make this strategy doesn't work, I'm not going to make this money, that basically translates into how you're going to be trading. And what you think you actually manifested, it becomes a reality. So if you do not believe and have confidence in yourself, that will manifest in how you're trading. You'll actually trade against yourself. So it is very powerful that, your mind is a powerful thing, and you need to develop good habits. Positivity, even if you have to wake up in the morning before you trade and tell yourself good things about yourself, just so that you can gain that confidence. And really, trading is a mind game. It's not really about trying to predict where the market is going to go. It's more about how you're going to handle what happens in the market. And the people who handle it best are the ones who become successful. The ones who are not able to handle what happens in the market in a good way, then they end up making losses. So it is actually a mind game.
Okay, my biggest take on psychology is how we think about money. So you know that money has some type of value. Money is options, yeah. So if you have, let's say, $200, those are options you have. You can go to Mombasa, or you can go $200. But there are things you can do. So when you put that money on your trading account, then you're comparing options you have in real life and options you have on your MT4 or MT5. So when you make a loss, then you start thinking of the other things you would have done with that money, like a budget trip again. So I think the biggest take with psychology is, first of all, always play with money that you're willing to just lose. That's the first thing. Until you get used to it, that's when I can risk more money. But when you're starting out, I think it's just important that you just have money that you're willing to lose.
Yeah. I think the next webinar is before the looking at last indicators. Maybe you can give a snapshot of a brief.
Oh, yes. Now, in fact, I believe I'm having a class where we've gotten to this topic for leading and lagging indicators.
Yeah.
So what happens is that when it comes to indicators, and the reason why people have this challenge with indicators is not knowing what indicators to use in the market that you're in. So the first thing you have to know is, what kind of a market are you in? Are you in a trending market? Are you in a ranging market? And what are the best tools to use in that kind of a market? So classifying them into leading and lagging indicators, and also classifying the market that you're in into either a trending or a ranging market, that will help you get better results in analyzing. So for example, using oscillators like RSI to do swing trading in a trending market, of course, you're going to get quite a number of trades wrong. But if you're using it in a ranging market, like those exotic pairs, I think there is one that tends to range so much. It's euro versus the Danish krone. That thing is always ranging. So if you're using something like RSI stochastics, you're going to get most of those trades right. But if you use moving averages in that kind of a pair, you're going to get most of your trades wrong. So it's good to, first of all, identify the market that you're in. Are you in a trending market? Are you in a ranging market? Of course, it's easier said than done. But you can also just look at the historical movements of that pair. Does it tend to move between two particular points, which means it's ranging? If you zoom out on a higher time frame, then it means that is normally a ranging pair. Or does it tend to trend a lot, something like euro versus the Turkish lira? That thing has been on an uptrend since the establishment of the euro. So in that case, with that kind of a pair, then it's easier for you to get it right when determining what your trend is. So stick to markets that you can understand. Don't just jump into any market just because it's available to you for trading. Identify the markets that you understand, then select the right tools for that market.
Yeah. And moving on to the next one, we did one with a lady who owns her own brokerage firm in Vegas. We love this lady so much, Kaligana. She's a commodities trader, and she was basically talking to us about the right metrics that you need to use when you're trading commodities like gold, commodities like agricultural commodities. And the takeaway for us was looking into higher probability setups when you're trading commodities, and that will be able to help you trade modestly and profitably. Yeah.
I think with Kaligana, and when we talk to traders who began their journey in the trading floor, maybe they're trading futures, then later on options. The kind of thing that we see with our guests is that they specialized in one particular kind of asset. So be it oil, be it, I think it was timber, I think for one of our guests. So there was one particular market that they zoned into, and they decided that that is the market that they're going to trade. And that is because they had the time to understand what affects that market. So what I took from Kaligana is that that importance to zero in on a market and be able to understand it inside out. Know everything that affects that market. Because once you fully understand it, then coming up with setups for trading is not going to be, such a difficult thing. But when you're trading, when you're a jack of all trades, you're in this market, you're in another market, you're in another market, when are you ever going to understand, how something works? So specialization is what I got from her. It's good to specialize in something. You can advance from there to other things, but it's good for you to understand at least one market, understand it inside out. It's a chart that if you open, you can easily tell which way the market is going just by observing it. So that's what I took from our interviews with Karen.
Yeah, so even the very fact that you talk about specialization, it means that you have to go beyond what you see on the charts just to understand how this price behaves in maybe certain times of the year, certain days of the week. And it really shows how in-depth you need to go to be able to trade some of these assets profitably. But then the paradox is sometimes you can be specializing in, say, gold and silver, and you find that you go on months or weeks without a single trade. So there's like a paradox, and there's like a trade-off between how far you can go in terms of trading and the opportunities it presents you when you understood the market.
Yes, and maybe just to add on that, it is to being able to understand everything both inside and out. So even that argument that technical analysis is the only way to analyze the market, or fundamental analysis is the only way to analyze the market, I think you need to have a holistic approach, because you have to understand what is causing demand and supply in the market. And also being able to identify that demand and supply in the market in form of technicals. Then also there's a group I belong to where people only trade four times a year. There are only 4 setups in a year, and they've specialized on those 4 setups in a year. So I think when it comes to understanding what you're doing, knowing the edge that you have in the market, from there, I guess it's not just a mind game. It's just not really limiting yourself, but preventing yourself from engaging in other kinds of activities or other trading activities that do not increase your profitability. So if you only have 4 trades in a year, but those 4 trades are the ones that make you the money and you're sure about it, then stick to those 4 trades in a year. Why gamble in the market on things that you don't understand?
Sometimes they have itchy fingers that just want
you just constantly want to trade.
push a button.
Yeah.
So it also ties in back to psychology and discipline.
Yes. Yeah. All right. From there, we went to.
I think there's one that David England did.
Yes. This one.
Samson, I think you were there when we were having this one with David England. He's well, he is a professor, he's an associate professor at a college in the States, and he was speaking to us about trading and successful trading and investing in systems. And yes, he was comparing his trading system. It's called the Simple Simon Systems and Garden Growing. And there was this challenge that he did with Jim Cramer of CNBC. And apparently he proved him wrong at some point. But we were looking at the stock indices and how to trade them. And being a professor, he was giving us a theoretical approach on how to trade in stocks, especially and stock indices, and how you can actually be able to leverage on the technology that we have to be able to trade on those specific asset instruments. So
I think going forward also,
Yeah.
we should have more of these trading challenges, even locally, so that show that it's also possible to actually do it. Because most of the stories are not from them.
yes,
Yeah.
yeah.
Yeah, and I'd also say that this aspect of, I think it's been a very decades long kind of an argument about outperforming the market. You know, when they talk about efficient market hypothesis, can you beat the market? Can you outperform the market? And just even to add on what David England said about some of the stocks that were the, what we call them, the other stocks that people made the most money from, and that was last year, 2020, and I think some of them are still doing quite well this year. Those are not stocks that are there, that have been incorporated into the index. So what happens is that the index is also a bit lagging when it comes to trends, because it takes time for them to remove some of these stocks that they feature in the index and remove the ones that are not really, present in the market. So the aspect of being able to beat the market, I would say that it is possible to beat the market. Though for safer investors, they'd rather just stick to the indices. If you're not going to be active in the market, but you still want to get some good returns, you can just follow the indices, what the indices are doing, or follow the stocks that are featured in the indices. But if you want to outperform the market, then you have to go over and beyond that. For example, Tesla, what Tesla did 2019, 2020, that performance was, out of this world. Amazon, same thing. Though those ones are featured, I think Amazon is there, down. Not sure about Tesla. And also some others like GameStop for this year. Yeah, GameStop. That one, I think I only knew about GameStop just from the video world, for consoles like PlayStation and all that. You'd hear that, people queuing for PlayStation 5 at Best Buy or at GameStop. So I didn't know anything more beyond that. But to find that it was such a hot stock this year. Was it this year or last year? I think it was early this year. So, it's quite interesting that you have to go over and beyond. So you just have to invest in knowledge. You can't beat the market doing what everyone else is doing.
And he was also insisting on technology stocks during the COVID time period. Stocks like Zoom, they did very well this year. Yeah.
I think there is debate, or there are cause of debate for having such conversations of whether can you beat the market or not, because you see, most of these active fund managers, the measure of their performance success is usually reflected into how much you've made over and above what the market has made. So for example, the year-to-date performance of the S&P is around 20%. So if I'm an active fund manager, then my investors will want to know, if I was just to put this money on the S&P, would I have made more than what you're giving me? And that's where the debate of can you beat the market really comes in, because that's how the performance is measured. So if, say, a manager makes 30% and the S&P is 20%, so the 10% is what is considered active gains on alpha, gains on active management, over and above what a passive investor would have gained.
Yeah, and I think was it Warren Buffett who also put that challenge to test? I think it was a 10-year challenge about being able to beat the market. So, there are nuances. There are those who are able to beat the market, and those who are not able to beat the market. And I think he won that argument where he invested in a fund that was tracking the S&P 500, and he was able to outperform a lot of hedge funds. So it's a tricky thing, and that is true that people are the fund management space. You are judged according to your performance in terms of the S&P 500, something like the S&P 500. I think is one they reference a lot. And I guess even for you as an individual investor, that is also a metric you should be looking at. So if at the end of your year you haven't been able to do, let's say, like 20% return, then are you better off just investing in a fund that follows the S&P 500, or should you invest more time in learning how to be able to perform better than that? But I think for most retail traders, since we use leverage, most who are successful will be able to beat S&P 500. But when you're now managing huge funds, I think now that's where the pressure comes in, because you have to reduce risk. Yeah.
And you also have to be more worried with the market. Because if you enter, say, a $300 million position, you have to be worried about liquidity and what price you're getting trading at. Because you see such numbers move the market. So it's a bit more.
Yeah. And even just to reference a local company that I think for 2 years now has beat the market, that is SIB with their Mansa X fund. They've done about 24%. And profits, I think, sorry, after fees, I think it's about 18.9%. That's what the clients are getting. So that is, pretty much being able to beat the market. And we have a local firm that you can reference for that.
Because now you're comparing with the local index.
Yeah. Okay. And then, yeah. The next one we did with Mandy Kaur, and she's a trading psychologist, and she was speaking to us basically about trading psychology. And me, what I can really remember from her, there's this common phrase in the trading industry that 80% of your success is attributed to your mindset. But what she taught us is that your trading skill is equally important also. So she was like giving a 50-50%. Like you cannot just have a good mindset and not be able to have a good trading skill for you to trade. So for her, it was an equal sort of balance. And that is how she views trading, and that is how she normally coaches her clients. So I think that is very important to take away from that.
What I took away from Mandy, I think that interview was quite eye-opening, because she mentioned something about your childhood experiences affecting you later on in life. Now we hear this, especially people who watch series, whenever you're watching, they're trying to evaluate a person's mindset based off of what they've done today, but based off of what they've been doing the entire journey throughout their childhood, what happened, because they're trying to figure out what led this person to do the things that they've done. So even when it comes to success, your childhood experiences, the things that you experience in your life, do play a key role in how they'll shape your mind later on, and how it's maybe going to be easier for certain people to achieve success, and it's going to be more difficult for other people to achieve success. So dealing with things that happened in the past, and that means having a serious conversation with yourself. I think in trading, we end up delving into so many things, even meditation and the like, just trying to find answers to the kind of things that, you go over and beyond to try and identify the root cause of some of the kind of maybe mistakes that you're making, trying to understand what is the psychology behind that. So for Mandy, she gave an example about what happened with her and her bigger brother growing up, and how she kind of feared, because of I don't really say it was bullying. It was more of like a big, when you have a sibling who's older, and the playing is a bit rough for those of you who have older siblings. So that does tend to affect you at some point in future. So she had to address that, and once she did, then it really opened up her trading, because it does end up affecting, it does end up trickling down into your trading. So yes, it is ideal for you to address some of those things that happened in the past, even if you don't want to unlock, you don't want to go knocking on that door. But if you're going to do professional trading, there are certain doors you have to go knocking at and opening certain closets that you'd rather remain closed, because you need to understand the root cause of some of the trading challenges that you're receiving, and that's basically what's influencing your trading personality.
Coming to the skill versus psychology balance, I think it's a very tricky one for even an individual to understand what they should be focusing on. Because, for example, say you have a strategy you've been testing out and it's been losing money, that it's been making you losses. But then, how do you know at what point it's the strategy that's the problem, or it's your psychology that's coming into play? And I think that's where maybe having a mentor also can sometimes assist. And yeah, it's something even professional traders still have to grapple with.
True, you're still, there's this aspect of having a coach, be it one who coaches you mostly for your psychology and risk management. So you find even the best traders out there have coaches. So don't be shocked when you hear also one of your mentors having a coach as well, right? We always look up to some different people for different things. It may not be for strategy, it may just be for being able to bring maybe the kind of chaos that you're experiencing in your trading account, to be able to just streamline all that and start making the right decisions. So always having a coach or having a mentor is quite important. For those out there who are self-taught, at some point you'll still need to reach out to people. So always have that at the back of your mind, that you will still need to reach out to someone who's more advanced in the market.
It also adds the time required to master the skill, because when you're self-taught, it takes years. Yeah, like some of us have taken 6-7 years just to get to where we are. So if you have someone or a group that at least you can get some of your lessons from, then it really shortens the time it requires for you to actually start trading.
I think we referenced Stefan from last year. Yes, that one is from last year. Yeah. So the next one was Anka Metcalf, and Anka Metcalf, I don't know why, but I get fascinated by these women traders. She has her own company. She's called Trade Out Loud, where she has her live trading room as well. And she trades everything from stocks. She's a swing trader. She's also a day trader. You remember when she was talking about switching time frames, and you can both be a day trader and a swing trader depending on how long you hold on your positions, as long as your risk allocation is proper. So she was basically saying that depending on the capital size that you have, you can choose to be both a day trader and a swing trader. You don't have to be either or. And she was giving us live chat examples of the same, and how she was doing her trading and how she calls out trading her trading room, and also how you can get in touch with her. So that was the lesson from Anka.
Trading routine, I think, is also something that I got from her interview. The importance of developing a trading routine, just having a routine that you stick to, because you said that behaviors, they're learned. So if you have, bad behaviors, it's because you've learned those bad behaviors. If you want to adjust them to become good behaviors, then you again have to enforce that. So it's all about learning and enforcing. And it's the importance of having good trading behavior, or rather just streamlining everything that you do before you trade and even after you trade. So that trade routine is important because it's able to help you stick to what you're supposed to do. And the more you do it, it becomes a no-brainer. You don't have to start forcing yourself. One of the things that I used to have a challenge with was recording, journaling my trades, and doing a self-audit at the end of the week.
It's a painful process sometimes.
That was such a painful process because you keep seeing repetitive mistakes, and you're like, how is it? I have to find a way to justify this because it's repetitive and I'm not being able to get rid of it. But you still need to do that self-audit, and in time you'll be able to let go of some trading challenges or mistakes that you make. One of the mistakes I used to make, and it got me some time to get rid of in my early years, was moving my stop loss further into loss because I didn't want it to be hit. And
Loss aversion.
yes, loss aversion. I kept on moving that stop loss. Nowadays, if anything, I move it, I trail the market with my stop losses. I don't move them further from where they are. So yeah, the importance of developing a trading routine and sticking to that routine.
And then first on the journal, I think some people just are okay with your account history being your journal. You know that history you go and click on MT4.
Yeah.
But a journal has to be more than that. It has to be a reason to took the trade, what state was the market in, and there are all these reasons that you have to factor in and just record, so that when you're coming back to review your trades, then you have a clear understanding. So it is more than just account history of trades. Yeah.
Yeah, because they're usually like three. There's the account history, which is basically the numerical part, but then there's the decision process.
Yeah.
What led you to, what kind of analysis were you doing? What led you to open that transaction? What led you to close that transaction? And then there's now the summary later. So it's a post-trade analysis, just the same way we have a post-match analysis, where we point out all the good things and all the mistakes that were made. So just for all of you who are sports fans, you know the importance of having a post-match analysis. And so you must have a post-trade analysis.
And then lastly, on the short-term versus long-term trading, someone has to be very aware of the merits and demerits of each. Because one of the things that like someone should consider is like the costs. If you're doing short-term trading, then you're trading probably every day, and that can be huge costs in that, like swaps or spreads or commissions. And then also if you're trading long-term, there are also costs, because if you're holding a position, sometimes the swap triples like on one place. So those are also costs you need to factor in. So going forward, you have to be very aware of the strategy and the costs, because trading is a business at the end of the day. So there are the costs of the business that you have to be aware of.
Yeah. And just to add on to John here, there's also another trader that we interviewed, and she was talking about the power of pen and paper. Like when you write something down, it registers in your brain. So it's very important to actually write those mistakes or those successes down.
Because for me, I have two journals. I have the physical one, then I have one on my Google Sheets.
Yeah. All right, I think we can move on to the next guest. Yeah, the next guest that we were having was Jeremy Newsome, and we were talking about dealing with, he's an open, he trades the market open, and we were talking about how to deal with noise as a trader. And we know that during the market open, there's a lot of information. Yes, and there's a lot of information that comes in, and a lot of opportunities also that come in. And because he's a gap trader, he normally trades the gap. He was basically showing us how to trade the gaps using different, as a stocks trader. And so the live chat, I would ask guys to go back to the YouTube channel to reference the live chat analysis for more lessons, because we won't be able to narrow down everything in this session. But I would say that trading the market open is actually a very good time for traders to take advantage of, because of the volatility and a lot of movement that you can capitalize on as a trader, especially as a forex trader.
Yeah, it can be very, very interesting, because at market opens you find that first the market has momentum. So if you're someone who scalps, that's the best time to scalp, especially if you have what you call level 2 data. It's a very interesting field.
And I've actually come across a lot of because American traders like trading the stock market more than FX. So you'll find that a lot of these traders usually trade the market open. They say the first 2 hours of market open is everything. You've either made money or lost money, but after those 2 hours, you're done for the day. Yeah, so if you booked a loss, that's it. You wait for the next day. And also what they do is they do the just before pre-market, it's called pre-market analysis, where they're looking at all the information that's coming out. So they usually, like, it was a very detailed, I think with him and also with another guest, if I remember, as we go along, where they look for certain type of volume in the market, because volume is really important, and that ties into also the level 2 as well, being able to see the volume of transactions and demand or supply that is there in the market. Then from there, they narrow it down using a short list. So you have to have a trade short list where you're trying to group all the different opportunities. You can't take advantage of all, but then you can narrow down to the best, the most high probability trades.
Yeah. I think we can also have a session on this, I think, one of the time in the future. Because if you're wondering how to go about this, I think the best place to start with is trading. You can have your MT4, but then if you have a premium trading account, you can actually see pre-market data and actual volume, not actual volume. So if you're wondering how do I integrate this with my scope markets MT4, that would be a good place. MT5. That would be a good place to start. Just have the trading view that's paid for, and you can get all the, it's an advantage actually. If you're trading market opens.
And I've also noticed that with trading, you can actually access different broker servers from trading. So it can actually end up being your primary trading platform, even if you're still trading with stock markets or any other broker. You can still plug into their servers from there.
Because for 1,400 per month, I think it's a good investment if you just do that, because the data keeps you at an advantage over so many traders.
Yeah. You're able to also access other traders' performance as well.
Okay.
All right. Yeah, I think we did one with Dennis as well. He was talking about getting to know the major currency pairs. Oh yeah, so as Forex traders, it's good sometimes when you're beginning to trade to focus on the majors, and that way, and then you can be able to go to the cross currencies as well. So can I add on to that?
Yes. Generally, when a trader is starting out, you'd want to start out with the pairs that have the most volatility, because you can be in and out quickly with minimal slippage. So just like Sam was talking about trading costs. Trading costs come with, the different trading costs depending on the pairs. For example, a reference like Euro Turkish Lira, and that one does have some very high swap fees. Yeah, for trading, actually, you're just going long on Euro Turkish Lira. It's a straightforward trade, but the swap, that overnight interest, can really eat into your profitability. So starting with the dollar pairs or the major pairs down to the USD, you find that because they are traded a lot, there's minimal chance of slippage. You'll be able to get in and out at roughly the price that you quoted to trade. And also the swap fees tend to be low for those majors, because if you look at the major 8 currencies, their interest rates are all below 1%. I think, I'm not sure New Zealand or Australia have gone above. Those two tend to be the ones that go above 1% the fastest, but all of them are under zero. So even when you're pairing them together, the swap fees are not going to be that high. So you'd start with those ones, and then now for specialized trading, you can find your niche maybe in an exotic pair, or in one of the cross currencies that are there. I've come across traders who may specialize in, let's say, AUD versus CAD, and they've understood that pair completely, so it's not part of the dollar pairs, but the fees are still manageable. So it's advisable you just start with the dollar pairs, and then from there you can go, because the exotic pairs, there's some very good patterns that occur. You may find that there's some exotic pairs which are very predictable, but it's not ideal for you to start there.
Because also when you're doing exotics, then you have to even go even more with the chart.
Yes.
If you're doing something like Norwegian krona or something, then you have to also understand what are the macro fundamentals of this country you're analyzing, especially if it's two exotic crosses that don't have the dollar in between. Then you have to really, it goes back to the point of specialization and understanding it beyond just what you see on a surface level. Because you can just take an indicator and apply it across any pair, but then it takes more when you're doing an exotic, because now you have to really dig deep to understand.
True. Actually, my interest in the Turkish lira came from a bank dealer. He was a treasury head at one of these banks in Kenya, and he had like the knowledge he had about Turkey.
Yeah.
He could tell me the history of Turkey for like the last 40 years, everything that they've done, what measures they put in place to kickstart the economy, what the challenges are. Like he gave me a brief 20-year history of Turkey, and that just wow, I was like, wow, okay.
And that's where you create your head actually.
Yes, that's how you create your head.
Pops up there.
Yeah, so that was like from now a macro perspective, from fundamentals. And that got me interested in, okay, let me look into these exotic pairs, but you cannot be surface level, like someone said. You have to go deeper. You have to understand that economy. And you also have to be looking at the reports and the fundamentals that are coming out from that particular economy. So it's very specialized, but you know, if you do decide to take that route, there's a lot of work involved, but yes, it's still a worthy cause.
Yeah. Yeah, we'll answer them once we conclude. Yeah. So let's do- Mm,
Oh, we uploaded it.
yeah. So, yeah.
This
then-
was last year as well.
No, that one's what we're going to change. That's fine.
Okay.
Yeah, so the next webinar that we did with the founder of Abujani in Kenya. His name is Roberto Chen. He's big on stocks and also offshore stocks. And so he was basically taking us through stocks that he normally looks at, then the criteria that he normally looks at for his choice of stocks, and how to have an edge when you're trading, international stocks. So it was a collaboration that we did with him, and I think guys can reference that webinar for more information. He's also been doing webinars with Scope Markets. So basically the stocks, how to screen for stocks. And he also gave a site called Finviz, I guess, that you can use as a screener for investing in stocks. Yeah.
What I took from Robert, because Robert has also been doing webinars with Scope Markets. He's been having a series, I think it's a masterclass series of how basically to get started in stocks. So that's the one that, actually having watched our webinar, you can also access his webinars ones that he's done with Scope Markets as well. There's a wealth of information there. And stocks offshore stocks are becoming very popular here in Kenya. And I guess it's because of the liquidity and also because of Kenyan diaspora. I'm also in a group with Kenyan diaspora and they're trading stock options. I don't have that knowledge for stock options, so I tend to float a bit. But these are Kenyan diaspora and they are trading, really trading on those platforms, be it Robinhood or something Schwab. I forget that are major stockbroking in the US. So I would urge you guys to also consider looking into stocks. I know we talk about Forex most of the time, but there's a lot of opportunity by looking at US stocks and offshore stocks. Currently, there's stuff happening in China that I was reading about. There's a real estate company there that seems almost like it's about to go bankrupt, and it's a major company. So the world is on the edge right now. They don't know whether it will be bailed out by the CCP, that's the Chinese government. We pretty much are in almost a situation like 2008, where Lehman Brothers was allowed to collapse, and that brought in the financial crisis. So we're kind of seeing that happening in China, and being aware of stocks, you're going to be able to track all these things. So you just don't be one-sided and look at Forex only. Look at also stocks and see how those effects can trickle down here to Kenya. So right now, I think China is on our radar at the moment.
China is an interesting, it's called Evergrande.
Yes,
Evergrande. Yeah. So you've seen, actually, if you're doing Forex, it's also advisable to look at other markets because they feed into your thesis of why you're trading steady progressively. Because something like EURUSD it tends to trace stocks.
Yeah.
So if stocks say if there is a bull run, so that means that investors are on a risk on mode. And it means USD will also be risk on because guys will be rushing to European stocks, meaning then euro itself will be bullish. So it's also interesting to just do some intermarket analysis and see what's the mood of investors because they are all interconnected at the end of the day.
Yes.
Yeah.
Yeah. Mhm. Yeah, then we looked at one with Mark Rendall. Mark Rendall is also, I would say, a core partner to Stephen Goldstein. They deal with higher performance coaching and trading psychology. And so he was talking to us about how to effectively nurture your trading mental capital and how that affects your trading performance. So just going back to I remember vividly when he took us through a meditation session. We've never had that on the webinar. So that was really, I think that was my takeaway. So basically, before you start your trading day, it's good to settle your mind first and your thoughts. And for some people, even when they wake up, they're really not awake. So you need to, first of all, take a moment to yourself and just breathe in and out, whatever works for you. I think that was the takeaway, just settling your mind and calming your mind down before going directly to your office or your chats or your laptop, whatever device that you use. It's really important to invest in your mental capital first, because then when you lose that, then you have no business trading.
Usually, like what I also got from him is basically what we see from other successful, especially successful entrepreneurs. You'll realize that they tend to have a particular routine before they allow the world into the rest of the world into their space. So, like waking up, deciding that, okay, I'm going to exercise, I'm going to, do my prayers, do, whatever kind of me time that you want, be it praying. If you're not a spiritual person, maybe it's something else. It could be the Eastern, type of things, be it yoga or whatever. And then, settling in, reading, and then just, setting your mind so that it's ready for the kind of chaos that's about to come your way. Because as entrepreneurs, as a trader, you consider yourself an entrepreneur, right? Yeah. So, before the chaos comes into your space, you have to be in control of your mind. You have to be in control of your space. So you need that time. But, just waking up and then the first thing that you do, you're right into the markets, you barely even washed your face.
That's also really hard to do consistently.
Yes, it's going to be a challenge. So you need to invest that time. Again, this thing for mindset, it's all through the interviews that we've had. Mindset plays a major role in trading and also in entrepreneurship. You'll hear it from all the greats who've written books about mindset. So do everything you can to protect your mind and to nourish it.
Because making that switch from, okay, all our lives, maybe you've had some sort of supervision from primary school, their teachers, campus, their lecturers, at work, your bosses. But then when it comes to trading, and especially if it's just individual trading, there's no one supervising you. So making that switch from being supervisor, you have to work to where you choose to work on just open the computer, especially if you have losing days. Waking up the next morning to just trade can be quite a challenge, and that's why mindset and having a routine is important.
Yeah.
Because it really just tries and systemizes what you're doing a bit.
I remember there's I can't remember exactly who the author is, but there's a quote that they said that the goal to success is not always doing what motivates you, but also doing the things that you need to do, right? So you don't need to, there's this whole thing of I need to be motivated enough to do something. No, the people who end up being successful end up doing things, even if they're not motivated to do it. Maybe they don't wake up that day, like some say, maybe just don't even want to go and trade, but you need to. So it's doing the things that you need to, not necessarily the things that, because motivation comes and goes. But you still need to do your job, you still need to be in the market, you still need to do whatever it is kind of business that you're doing. So doing the things that you need to do and not necessarily placing that other asterisk that it's only when I'm motivated.
Yeah.
That can make trading really difficult, because imagine if you've been making losses, say, this week from Monday to yesterday, and your main driver of I'm going to trade is motivation. Then you find yourself not touching the markets for the next 2-3 weeks, and then coming back from square one, analyzing and getting into the mood of the market, which is also takes more time. So you end up getting into this cycle where you're not really making progress, because you're relying on how you feel to trade.
Yeah. I think you can touch on the fundamental analysis in trading, the one that you did.
Oh, yes. So a lot of the time, whenever I used to do other private webinars, and I used to, do them in conjunction with other traders, what used to happen, and this is not with the STL, this was like years back. What used to happen is most of my colleagues used to be pro technicals. So each time we'll talk about fundamentals, they'll always come back and say, this thing of fundamentals, blah, blah, this, blah, blah, blah. So, you have hardcore, hardliners who are, it's Fibonacci and it's only Fibonacci that works. It's VSA, volume spread analysis, only volume spread analysis. It's Wyckoff method, it's ICT, it's, I don't know, BTMM, but the goal here is you need to understand not just what's happening in the market in terms of the moves, but also what is driving, what is causing that supply and demand, what is influencing people's behavior. In the market, yes, you see a support, yes, you see a resistance. Why did that support and resistance form? Technical analyst will tell you it's because of Fibonacci, it's because that's a moving average 200, SMA that the market has come to bounce on. It's also a debate as well. Oh, it's a historical, it's a psychological level. It's those doubles, 0-0 levels. There'll be all sorts of answers. And even one of the rich answers is, that's the market algo. That's what I usually hear when there's no explanation. The unseen, that eye that observes the matrix, the eye, the whole thing eye, whatever people call it. But the truth of it is that you still need to understand why there is the market sentiment, because market sentiment is very crucial. You need to understand why are people behaving the way they are behaving. Why are we seeing sellers more than buyers? Why are we seeing buyers more than sellers? Why is the market undecided? What's causing that indecision in the market? And this is what fundamentals help to do, because fundamentals is not just to do with macro and geopolitics. It's also to do with behavior. Being able to see people's position,
Tracking the right behavior.
and tracking the right behavior. So there's also like some of these contrarian indicators where you can go and see how the retail market is positioned, how the institutional market is positioned, why are they positioned like that, and why does it seem as though the retail traders seem to be opposite of what the market makers are doing. So why is it that there's always that discrepancy? So it's good to at least understand some of these things, not just macro and geopolitical, but also now getting into behavioral science as well.
If a big part of the market is moved by institutions, then we want it to be prudent to try and see what institutions are doing. And one of the questions I usually ask someone when we have an argument with technical, fundamental, macro is, if I was a hedge fund and I had I want to initiate, say, $1 billion position on something, will I really do that because I saw a crossing moving average or support resistance? Or will I look for more reasons to actually justify my trade? Because remember, you have this money in the line.
Yeah. True. Actually, just watch the series Billions. That will explain to you that you're not going to see any people there doing technical analysis. It's all about information. Getting the, though of course that or now they are doing inside information, but you can see why information.
You really do need to dig deeper. That's the same message at the end of the day.
Yeah, so that's the underlying message. You cannot put all that money on the line just based off of a technical pattern you're seeing on the chart. There has to be something bigger than that, because the institutions are moving billions. You can't do that based off of a moving average.
And that actually tied with the webinar that Dennis did on Economics 101 for traders for making sense of economic data and also referencing the economic calendar to know what is happening. I think it's one and the same thing. We can Capita does one and the same thing.
Yes.
Yeah. Yeah, so then the next one that we did was with a quant called Matthew Tucker. He is a chartered market technician. He is basically a Python coder, and he was talking about systems trading. And just to go back to the first interview that we did with Tombe, so every interview that we did with automated traders, it goes back to the simplicity of your trading rules. You know, you can use those, you can start with those rules from a manual system, but you can have them coded to work for you. It's as simple as that. It goes back to your trading rules. So really just transitioning from a manual to automated system, it goes back to your trading rules. So there's really nothing to think as complex. It's just the rules, your trading rules that you apply now on an automated trading system.
And also what I got from the quants that we've interviewed, especially Matthew, is it's easier if the automated system that you're using, you have put in your own input into it, other than getting these black box systems. A system that you don't even understand how it's operating. I think that's usually the challenge when you come across people who have an opinion, most likely a negative opinion about automated systems, is that they came across a black box system. They don't know how it's operating. It has a very good backtest data results, you know, and you're trading now off of that, off of what the programmer has given you. This shows that it's done well in the past, so it should do well in the future, but you don't even understand what it's doing. So there is that importance to understand the rules behind an automated system, especially for those in the audience who might be thinking of going and getting an automated system. There are very many websites, and Q5, you'll see them there. And what I usually advise is that look at the live trading signal to be able to understand whether it has a chance of success in the future. So if it's not just backtest data, but actual, you know, real data in trading, because there's usually the backtest where you test it, and that can be fine-tuned to show false results. You know, there's something called over-optimization, where they optimize, they change, they tweak such that when they do the backtest, it seems, you know, this thing is perfect. But when it comes to real-world trading, you know, it's completely different. So I would also advise, because I've been getting this question a lot about, you know, what's the best automated system and that. There is no best automated system. Learn to understand the system that you're going to use, even if you're going to purchase it. And also look for live market performance of that system. Don't always go and rely on the backtest data, because that's something that's been happening a lot. Because it has the backtest, you rely on it, you know, look for live signal as well. And keep your system simple. If you're going to develop your own automated system, there are some very complex ones out there I've tried to understand, I think even for more than 5 years, and I still don't understand even the settings. The settings that you can even tweak, I still don't understand about 70 of those settings. I came across a really complicated one. So it is best if we use very simple rules. You know, keep it simple. I think that's what I would say.
I think it's best if we had more. Okay, we had some sessions on automated systems, because one of the things that when I was experimenting with automated systems was the challenges was you only have MQ4 and MQ5. So for me, it took some really long time to realize that if your broker doesn't have an API, then there's still ways to bypass that. And just straight from MT4 or MT5, have a way to relate with a language you're actually familiar with. So if you want to do automated trading with, say, Python or whichever language that you're comfortable with, there are still options. And I think there should be more discussions also with that going on.
Yeah. Because guys, we'll have more webinar sessions in the future with STL. So we'll be having more discussions about these topics as well. All right, so, and then we did one with Bryn Kelly. Bryn Kelly, she's big on fundamentals and energies trading on natural gas and and oil as well. So I think we can touch more about Bryn Kelly. She's more of an energies trader, and she was speaking to us about fundamentals of trading oil. This time around, we were discussing oil, and we're discussing crude oil and both the other one, Brent. So I think she was talking to us about seasonality and the patterns that are observed in trading oil. And there was this time in the year where there was a ship that was stuck at Suez Canal and the effect on that on oil traders. And she went extensively to discuss to us about what seasonality plays in terms of, it's basically demand and supply as well when you're trading oil, and how that affects oil traders. So my takeaway was observe the seasonality patterns when you're trading energies and commodity energies. And also, she also touched on a concept called backwardation. And I think guys can reference to that webinar for that as well.
This again just adds on to what we were saying about specialization. If you look at her career and all, this a lady who got into the commodities and specifically the oil market, and that's where she learned, her trading, being able to work now on the other side. We call it the sell side, or the institution side. And being able to see exactly how this demand and supply flows, like even the logistics of this oil, being able to transport it from the oil fields, all the way to the market. And it's actually from her that I learned the difference between Brent and US oil, which is WTI, the pricing, because I always used to wonder, why is it that these two have a different pricing? And the explanation that I got online was that with US, if the economy is doing really well, US oil will trade at a premium. But if the global economy is not doing well, then it's Brent that will trade at a premium. But it's her who actually explained that the reason why we're seeing that kind of mispricing is because of with US oil, it's more inland, so it's not at the coast. And in order for them to compete with Brent, because that's not North Sea, yeah, it's in the North Sea. Somewhere in the North Sea, they get that oil from somewhere in the sea. So their rigs are actually in the ocean. And it's easier for them to transport because the boats just come and just pick the oil and go. So in order for them to compete, then they have to, sell it at a discount, because there's still going to be the transportation costs to the coast and then wherever it is that it needs to go. So that was quite interesting. And again, if you're going to narrow into this kind of a market, like trading natural gas or oil, then you have to understand even the logistics of it. I remember coming across guys who trade the orange juice futures, and I was wondering, orange juice, I thought it should be oranges, not orange juice futures. And these people look at all sorts of things. They even look at those weather patterns that come into Florida, because most of those oranges are grown around that side, and how some of these hurricanes can affect the production, or even it's a very intricate kind of a thing. And it just means that don't just be surface level, go deeper into it if you really want to understand what you're doing.
I think a good example would be last week, but when we had the hurricane or the earthquake in Mexico. So
It had landed.
And we saw supply shocks. And when the supply shocks, then the price starts running up, and that's why the oil price is running up. So if you're a technical analyst or a technical trader who looks at fundamentals, then it's bullish. So you won't be taking any signal that's telling you to sell. And you see that's where the advantage of knowing the fundamentals, even if you're a technical trader, comes in. Because now you can filter out any signal that will have maybe resulted into a loss.
Yeah. All right. So which one is the next one? We did one with John Locke. John Locke is also a performance coach and a trading psychologist. So he was talking about managing your expectations as a trader. Yeah, managing your expectations as a trader, discovering why your trading expectations affect your trading performance. And you know, we come into the markets with different kinds of expectations, as we said, going back to our childhood and how we've grown up. And we expect the market to give us what we demand of it, you know, some people. But now knowing better, it's just managing those expectations. And the way you manage those expectations is just basically boils down to your risk and reward ratios. There's no other thing. There's no magic formula. It's just about your risk and your reward. And that was the takeaway from this. And he also went into the deep conscious and subconscious aspects of our mental state, just to get to understand ourselves better. And once you understand how your psychology works, then you're able to approach the market with a better or an informed mindset, I would say. Yeah.
When people hear about hypnosis and and meditation, they start to think, okay, now we're going into pseudoscience. And the truth of it is that you will find that when you're in a very demanding kind of a profession, and I would say that trading is similar to sports, and that's the reason why you tend to have people who are in professional sports also getting into trading. There seems to be some kind of a mix there, because it's all to do with mindset again. And these things are not going to sound pseudoscience once you've been in the market for some time, because that's the time you realize you really need to go beyond even what you had originally believed is the limit as to where you should go. You need to extend beyond that. Now, something else that I also got from John Locke is this aspect of also managing your emotions. And it's a very delicate line between intuition and irrationality, right? You find that there are traders who talk about intuition, and intuition is very important because it's your subconscious that's telling you about something, but your conscious side is not being able to interpret it. And then there is now the irrationality where you're just, misbehaving in the market. You're doing things that you're not supposed to be doing, and you're doing it. So also being in tune with basically your intuition and investigating further, not just, blocking all that and saying, oh, this is emotions, I'll put it in one box and lock it. I'm supposed to be a rational trader. But remember, you're participating in an irrational market, right? The financial markets are irrational. They are run through irrational behavior. So you still have to understand what irrationality is. And also, don't block out your intuition. Investigate further. Why is your body reacting the way it's reacting to certain stimulus that's coming in from the market? So yeah, so don't just block out your intuition and just put it into a box that this is emotion.
I think one of the ways I used to manage irrationality was I used to have 2 accounts. So if I felt like I was going to make some irrational, stupid decision, I'll do it on the other account so that I don't touch the main account, which is where you see setups that you actually had planned for. So if you make money on these other ones, well and good, then you can investigate it further. If you don't, then at least it won't really impact your thought process.
Yeah, I also used to have 2 accounts, one for high risk and one for what I'm supposed to be doing. So each time that I will feel, no, I need to take a bigger lot size. I've been having a profit streak. So, I mean, why just bag $20 when it can be $200? Niende sherehe. So when that kind of an impulse comes in, I used to have a small account that I used to do my high risk trading. And that actually helped me to manage my risks a lot. A whole lot better. I don't think I would have been able to do it if I didn't have that separate account and then now be able to analyze the two after a few months. This a small account goes up and then it goes down. But this other one is a bit steady. So I'd rather just stick to, manageable risk.
And expectations create a sort of a paradox. So it's very hard to not, when you're told to lower expectations so that you don't have disappointment, then it creates a paradox where then if you lower expectations about something, you don't like it as much. And then it can lead to you not even wanting to trade anymore. Because coming into Forex, you really have a lot of expectation, and that's why most people like it. But then now you have to manage between what you like and the expectations about it. That's why it's very, very tricky.
I think that managing of expectation boils down to two things: constructive greed and destructive greed. Now it's up to you, to the audience, to go and find out what is destructive greed and what is constructive greed, because that will be different for everyone.
And just to add on to that, when you choose to have two separate accounts, it's because you're self-aware. You know yourself that this time of the trading, I am prone to making those stupid decisions.
Yeah.
So it takes a deeper level of
Just to accept,
self-awareness,
yeah.
yes, for you to be able to acknowledge that.
Yeah, because you can't just tell yourself, I'll stop being rational and
Yeah.
stop being rational.
All right. Then we had a trader from Kenya called Al Nawaz. He is a futures trader, and he is an order flow trader. And before we did his interview, we also did a webinar. Samson and Dennis also did a webinar on order flow trading, on introducing currency traders also to order flow concepts. So basically, this was an addition to that. And he is a futures trader, but he uses the concept of order flow trading. There's a lot on that. I would just advise guys to go back to that and look into that. So because if we start discussing order flow right now, we will not.
It's a really lot.
Yeah,
I realized that the introduction was also too compressed. And I said a lot of things that I shouldn't have.
Yeah.
I should have made it a bit later because it's too packed.
Yeah, so and there's a lot of data analysis that goes into order flow trading as well. So that one, guys, just go do your homework, and then we can just move on to the next.
Yeah, true.
Yeah.
So from there, also this order flow concepts.
Yeah. Yeah, maybe you can tell people more about point values, pip values, and trading, the one that you did.
Oh yes.
Yeah.
Now something that seems to be a recurring question, even when we go through trainings and even mentorship, is that aspect of calculating risk. It keeps cropping back, and it doesn't help that MT4, MT5 also get it wrong in terms of the terminology of people. When you're using the crosshair tool on the chart, it still talks about pips, but we increased, I think from around 2010, usually the pairs that don't have the yen used to have 4 decimals, and the ones that have the yen used to have 2 decimals.
Because the market gets bigger to a point where you need a few decimal.
Yes, so now they increase they put 5 decimal points and they put 3 decimal points, but the terminology didn't change when it comes to the crosshair tool. So the crosshair tool actually tells you points, and then again, even the terminology, points or pips, what does points mean? Does it mean the smallest point, the pipette? Does it mean points? So I just wanted to clarify, what all those terminologies are. What are pips? What are pipettes? What are points? What are ticks? So that as we're interacting with different platforms, you can be able to understand, and you need to know what those point values are, because it's going to help you assess your risks quickly. There are times where you don't have a lot of time to, start using a calculator to try and understand exactly how many dollars are you risking. So you need to be able to do these things often.
It can be confusing because you see, like, there are pips and there are points.
Yeah.
But then pips are also called points because it's percentage in point.
Yeah.
And so it just, but yeah, I think
It becomes an issue because points are mostly used in the stock market, and pips are the ones that are used mostly in the forex market.
Yeah.
And you may find that there are going to be different decimal points as you move beyond the forex market. So when you're trading indices, when you're trading commodities like of the metals like gold, silver, you may find that some have 2 decimal places, others have 1 decimal place, and depending on the broker, some don't even have. Like I saw Japan with the JP 225, the Nikkei, on one broker, they didn't even have any decimal points on that. So you need to understand, and you need to be able to know, how do you tell what 1 point or 1 pip is equivalent to? And then that will now help you assess risk in that particular market.
that forms the basis of how large should my position be, how far should my stop be. So,
Yeah. And then we also had another session with a professional trader. His name is John Barnes. He's a I don't know if you guys know Dennis Schall, but maybe you guys can go and look them up. And he's also a performance coach, and he was talking to us about recognizing your inner voice, basically what Gilbert was talking about, not ignoring your intuition, and how your gut feeling also communicates to your subconscious and your conscious mind, and also just more of the meditation and recognizing that and how that affects your performance. I think this year we had a lot of trading psychology webinars, which is, I think, crucial for any trader, whether you're trading forex, whether you're trading stocks, whether you're trading commodities or indices. And the takeaway is that do not ignore your intuition, do not ignore your whatever it is that communicates to you. Yes.
I think for John Barnes is the one that I'll always remember this interview because I had to go and meditate after this, after that interview, because it kind of shook my concept of what intuition is, because I thought intuition is those emotions, you're supposed to suppress them. You know, nobody ever makes money through, you know, these emotions, you have to suppress. And I guess that's also part of our society where you feel a certain type of way, you're supposed to suppress. But now this guy was talking about something totally different, actually embrace it. And if you read some of these books, like for the ones to do with hedge fund titans, I forget the names. I don't know why I usually forget.
Drunken Millionaire.
And there's this other one that, oh my goodness, it was referenced in the last webinar that we had. These market wizards, yes. You realize that most of these traders, successful traders, they seem to rely a lot on intuition.
Yeah, true.
Yet it's the one thing that in society we are told, no, suppress that. So John Barnes is the one who, like, you know, just made it connect for me. And I was like, okay, this intuition, I have to pay attention to it. Because I'm quite intuitive. There are certain things that if I followed my intuition, I think I would have been a billionaire right now, based off my analysis of the things that I've decided not to do based on intuition. So yeah, so this was really an eye-opener for me. And I'm now more intuitive. I really now concentrate on that intuition and to try and investigate why.
I think there's a scenario, I was reading somewhere, I think it's Soros. So before the 2008 crash, he invited his friends to visit. There's this estate that people go to in which case. So
Hamptons,
yeah, Hamptons, in his Hamptons estate. And then they were talking about the markets. And remember, he had not traded for like 10, 12 years. And he talked about it, and every other hedge fund guy in the room felt like it was still a bull run. And that's what made him go back and start trading before 2008. Because he had that intuition that a crash is coming. Yeah, so I think that ties into the point we're talking about earlier.
Yes, that intuitive feeling, it's maybe in future we'll be able to measure that with these people who are doing this, they call
Neurolinguistics.
neurolinguistics, and trying to discover secrets of the brain. Maybe they'll come back and tell us, oh, this intuition thing, maybe it's your genius state. It's only that you do not, you do not even take advantage of it.
And actually, one thing that you should notice that all these trading psychologists that we've had are actually traders. So when they're speaking to you, they're speaking also from a point of trading experience. So it's not just advice based on theory or performance coaching. Yeah.
No, I think that's the one we just done. So we had a few others.
Yeah, and then we had I think we can try and be more fast. I know we were doing badly on time, but this being our last webinar, it's okay because, guys, we're taking the lessons from this. So we had a session with Peter Tuchman. Peter Tuchman is up to date, a trader on the New York floor of the New York Stock Exchange. And he did promise us that we will have another webinar with his partner, David Green. And he was talking to us about trading the pandemic and how to trade during these COVID times. And I remember vividly, he actually felt sick during the COVID times. And my takeaway was that when he joked and he said we were getting his last brain of, he's an old guy, but he's also very sober, and basically the lessons that we got from him is that during these COVID times, there are opportunities that came to stock traders and especially stock indices traders, him being on the New York Stock Exchange. And so just knowing that during different market times, there are different opportunities that present themselves to traders. So we should be very open-minded to see those opportunities, whether you're trading on the floor like him, or whether you're trading online like for now where we are at. And also him giving us the differences between the historical times, between the financial crisis and how it was different, the history basically. That takeaway for me was, we don't always go back into history, but that made a lot of things click to present day market uncertainties. So that was our biggest takeaway.
And also, when you listen to these traders who used to trade on the trading floor, and the reason why they used to pay a premium just to be there, at times almost $1 million a year, just to have a seat at the NYSE. And the reason for this was because being able to assess what? Sentiment. So that still comes into play, sentiment. And a lot of the traders who used to trade at the trading floor, it was very difficult for them to adjust to online trading because they can't assess the mood in the market, that trading sentiment that we were talking about. So it was also interesting to listen to him and for him to say, that kind of a transition. There may still be floor traders there, but nowadays it's not, the kind that you can be able to assess people's sentiment. There are times you could be able to tell, oh, things are going down, and you'd be able to get out of your positions earlier before the rest of us see that famous meme of that red candlestick going all the way down, breaks your table, breaks the floor. So those are the guys who used to create those candlesticks, being a floor trader. And just that whole transition between that and now trading, and how every market crash is different. There are similar hallmarks, but every market crash is going to be different. Even this one for COVID. Personally, we were doing analysis to do with the bond market. That was in 2019. And around September, it was signaling that 2020 would be the beginning phases of a market crash. And this is something that's been used for many years. I think he got that from a trader, Paul Tudor Jones, in 1987. In fact, he's been hiding that interview for a very long time. Maybe when we get back to this, we'll see if we can get Paul Tudor Jones to speak to us. And, so my mindset was already prepared to start seeing signs of a market crash come 2020. But my mind was not thinking of a virus. So this virus came, Kangusha market, and I was just left wondering, okay, this is not the signs that I was looking for.
And even the recovery was
very fast. It's not how we've seen in the past, like with the great financial crisis. It was quite different.
Yeah.
So every crash, you may know or you may have an idea of when it's going to take place, but how it transitions into it and even the recovery is going to be very different. So you still need to be proactive. You still need to be reactive just as much as you are proactive.
Yeah.
So next one is.
So there was this. We can skip on the ones that we did.
Yes.
Yeah. So there was the next one that we did was about reactive day trading with Ryan Sellers. Yeah, Ryan Sellers. So market insights into reactive trading. This was specifically for day traders, and I remember him talking to us about the difference between a market maker and a market taker. He's also been on the floor of CME, that is the Chicago Mercantile Exchange. And so he was basically talking to us also about the red flags of brokerage firms and how to identify which brokerage firm that you should be able to trade with. for your interest as a trader, because unfortunately in our industry, you do have dubious brokerage firms. And so the differences between a market maker and a market taker and a broker who is interested in your interest, and education comes to play when it comes to a broker who's interested in your interest. And yeah, so looking out for those red flags when you're deciding to open a live trading account or even a demo account. And yeah.
And I think
so the finance, okay, the regulatory bodies are usually trying to play catch up. They're usually playing catch up with finance, but there's always new products, there's crypto, there's all these sets of new instruments you can trade. And the best thing you can do as an individual trader is just do your due diligence, because sometimes it's you shouldn't wait for like CMA to come and you can just do that on your own and just see if. And there are many places where you can see and cross-check and see if this institution or broker is safe.
True, and even just to reference that the regulators tend to trail behind the industry. Just look at how long it took the SEC to get, that's the Securities Exchange Commission, to get Bernie Madoff. This guy was running a Ponzi scheme from the early 1990s in the US. Yet there are people who knew, like by 95, they already knew this guy is running a pyramid scheme. But it takes some time. At times, what they usually say is we wait for the crime to occur, and then that's the time we come and investigate. So it's upon you as a trader to do your due diligence. Look for red flags with the brokerage, and just be aware. Be aware of the fact that there are different models for trading. Here in Kenya, the brokers are only licensed to do one thing. They're not the ones providing you liquidity. So it's called a non-dealing license. And all the brokers that are currently licensed in Kenya are licensed under non-dealing license. So they don't take the opposite side of the trades. They are liquidity providers who provide that liquidity. So you're buying, your orders are processed out to another liquidity provider. So it's also important to understand that the different kinds of models, the market making model where the broker is the one offering liquidity, and the challenges that come with that kind of an environment nowadays. Market makers, funny enough, back in the day, used to be the ideal, because they used to guarantee your entry, they used to guarantee your prices. So your stop loss would always be hit where your stop loss is. Your entry, your limit orders would always be processed where the price that you had listed.
For a very long time, even on, I think it was exclusive or something, they used to guarantee like your entries, but then people started taking advantage of that and they had to remove it. So there's not so many brokers out there. Like, they also try and, okay, in as much as brokers can be regulated, brokers also tend to be ahead of the game. So they also have their own ways of which they protect themselves. Sometimes it may not be very legal, but still.
But with non-dealing brokers, what happens is that they have to have a conflict of interest. Even with the market makers, the ones who do dealing, there has to be a conflict of interest policy statement that they issue to their clients, showing or stating that there might be conflicts of interest, and based off of the laws, they're supposed to manage those conflicts of interest in a way that does not infringe on your rights as a trader or does not compromise your trading. So some of those things are the ones that you look at, and I think it's easier here in Kenya because the license is daily, non-dealing, straightforward. When you go to UK and to the Financial Conduct Authority and you see what a broker is licensed to do, they're like 100 different. It's almost every single thing that the broker is supposed to do. So interpreting whether they have a dealing or a non-dealing license becomes a bit complicated. I wish people could take
also understanding basically how the market works. I think it should also be in like introduction classes just to see how the process and order takes, like from the time you click and before where it goes to which institution, so that you also understand, have a clearer picture of how these things are usually done at the back end.
And even during dispute resolution processes, you can ask the broker to provide you like their liquidity providers, because that's something that happens during dispute resolution when maybe an order was processed it almost seems as if there was a gap, between the point that you clicked at and the market does not show that gap. So usually that slippage, what we call slippage, it's based off of the liquidity providers, and it's a fast in, fast out kind of a fast come, fast out kind of a thing. So if you had clicked on a certain price and your number X in the queue, maybe the liquidity that is there is able to process you at that price. Maybe it's not at that price, so it will be processed at the next available price. So that's what causes slippage. And there's an easy way of being able to see that, yes, this broker does actually have liquidity providers and they were using this particular bank or this particular institution. That's the one that processed your order at that price. So it makes it easier also to do that.
There's an entire course called market microstructure, of which it just deals with how brokers operate and how the market operates in the back end. And then now you see someone talking about how the broker is evil or the broker is trying to take. It really shows the lack of understanding of what happens in the back end, because there is a lot that happens.
And blaming the broker really is not. I think it's an immature way to approach the market.
Yeah, because sometimes you can just ask. Like I didn't get my order. So if your account manager can't answer, you just walk in and just ask whoever in charge.
And also, if you find that maybe your trading, the kind of a trading environment that you require, especially for automated traders, is not being able to be satisfied, that the conditions that you're looking for not being able to be satisfied, instead of fighting with the broker, just look for one who can be able to satisfy that, because that's for very niche kind of trading, and it's mostly for scalping systems. Those high frequency trading systems that I think we talked about with our most recent guest, was in that things keep on changing, the edge keeps on changing. So instead of going out there saying all sorts of things about a broker, yet you don't even understand. My very first argument to the broker came about PIP valuations. This was back in 2009. I only knew one way of calculating the value of a PIP, and that is for pairs that have the dollars, the quote currency. That's the only one I learned. So I was trading something which had the Japanese yen, and the values were coming very different. So I was like, I think this broker is stealing from me. So got into an argument with the broker, and they educated me on the PIP calculation. So there are times where you may be arguing on things that maybe are actually just based on your lack of knowledge. So seek to first of all understand, and then from there now you can take action.
Or also criticize first, understand.
And a good broker gives you access to education, whether they will outsource it or if they have it in-house.
And questions like, what is an
Or the liquidity provider.
the IB?
IB.
Conversation of what is this?
Oh yes. That one has been a conversation, but for another day.
All right, we're almost winding up, guys. And then I also did a webinar on risk management 101 for beginning traders. I was basically introducing people to the rules of risk management and position sizing, the capital size, and the risk reward ratios. And then Michael Tedeschi came in now with a practical approach into risk management, where he showed us about him as a breakout swing trader, how he does his risk management. So he is a wealth management advisor, and we've had him severally on the trading lounge. And he is also an investor. So he basically manages a portfolio of assets for his clients. So the rules of risk management, we cannot stress enough. That is essentially what keeps you in the trading business. And I think that was the last webinar that we did in partnership with Scope Markets. For now, I think we will add on to that. Then we take a few questions. Oh yes, there's one more.
Yes, there's one more.
Let's add on to trading for a living with Rita Brata. Rita Brata is a professor at World Quant University. He's also an investor and a trader and an automated trader. I think Gilbert, you can share your thoughts on Rita Brata, please.
Yes, I think that aspect of first of all, that edge keeps on changing, and I think that's quite a challenge when it comes to automated systems. That you do find that people tend to keep on you have to refine and retune or calibrate your systems, especially the automated systems. just so that they may be in tune with the current situation in the market. So that's something I always used to struggle with. I used to see as if, no, it's just too much hullabaloo. If something has worked over a period of years, then it should continue working. The market is only going up, down, and sideways. But I think with Rito, he really stressed that point out that, you know what, edge keeps on changing because there are other people out there who are also trying to identify an edge. And if too many people identify the same edge, then of course the market is going to change. You're not going to be able to take advantage of that. And I'll tie that into the first times when I got into trading. I got into trading from taking advantage of price arbitrage, mispricing between bureaus. And that was my edge at that time. And that edge, no longer exists. A few years later, especially after the crash of the shilling, the first time it went beyond 90 shillings to the dollar, that was in 2011. A lot of brokers, there was actually not brokers, bureaus. There's a bureau that actually closed shop that Gilbert Towers used to go to it ground floor. And that's because they had mismanaged basically their dealings with the dollar. So from there, that edge was lost. They created a spread. They started harmonizing price. So that edge was lost. Nowadays, I don't know how people do it. So you need to keep on researching, keep on recalibrating your system. If you feel as if your system is no longer giving you the kind of success that it was, instead of trashing it, just go and refresh it and refine it. Because hopping from one strategy to the other, that's not going to work in the long run.
Market sensitivity to data tends to change over time. So, for example, in 2020, the market was very sensitive to COVID numbers. See, so it wasn't reacting as much to other figures as it was to COVID numbers. So you see, if you had a system that you're creating then, and it was tracking maybe rates of infections and lockdowns and all that, and not trying to come up with a way to trade, it might not work as well right now that the market sensitivity to such is reducing. So that's a good example of how the market responds to fundamentals and technicals. It tends to change over time.
Yes, and also even with fundamentals, I know some traders were trading the news last year was a bit of a challenge for them because again, just as what Sam has said, most of the reactions were to do with the COVID numbers. So even if you get these reports, macro reports, people would still kind of weigh them according to the COVID figures that are coming out. So some people lost an edge maybe for about a month, for about a quarter or two last year, but then that edge has come back now that the market is no longer that sensitive to that data. Also, the time when the former President Trump came into office, I know it was very chaotic that next year, 2017.
The market was sensitive to tweets.
Very sensitive to tweets because we perceive a president as being a key official in the economy. So it's almost as reckless as seeing, a central bank governor just, what is supposed to be tweeting to his friends is actually tweeting to the rest of the public. Kind of like what Nicki Minaj was getting into trouble just the other day for tweeting about something that happened to her cousin to do with COVID. And up to the point that, the health minister of Trinidad and Tobago, where she comes from, had to actually address that rumor that no, COVID jabs do not do this to your system. So it became, because she has 180 million followers. So it was quite a challenge trading also fundamentals in 2017 because of Trump and people not adjusting to his tweets. But right now, even if he says something, people don't take it serious. But during the first 2 quarters of 2017, it was, it's almost like people were saying the president was a forex trader because you'd come in and you just move the market in a certain direction.
Even the SEC had issues with it.
Yes.
Yeah. All right, guys. I think that has been a nice takeaway session. We wish to, first of all, thank Scope Markets Kenya for the time that we have served hosting this webinar series with them from 2020 to date and previous seminars that we've held with them in the past. We look forward to more engagement with them in the future. And then there's a question that came in about mentorship, and as STL, we do offer that in terms of coaching and education services. So you can contact us through our website, that is forexstl.com. You can also reach out to us through our email, that is info@forexstl.com or stls@gmail.com. And then you can also reach out to us through our phone number, and I'm gonna type those right here. Yeah, in the chat section, how to reach out to us. So you can reach out to us through our contacts here. And
So I think there was a question. Sylvia is typing in our contact details. Supposed to go back to also.
oh yeah, and attendees.
Yes.
All right.
So there's a question coming in from, I think that's Samuel. How do you usually educate beginners on how to trade? So for us, what we do is we have an entire course outline. So you can reach out to us and we'll be able to take you through, just that flow of information, how we do from chapter 1, chapter 2, chapter 3, chapter 4, what's contained in chapter 1, what's contained in chapter 2, 3, 4, and then the mentorship after that. So just reach out to us, and our contacts are just being placed in the chat area, and we'll be able to assist you even with our course outline.
Yes, and also you can go to our YouTube channel. We will be having future webinars and future interviews with our networks. So you can choose to subscribe, or you can follow us on our social media handles. You can reach out to them for the social media handles.
Yes, so our social media handles are at Sylvia's Traders Lounge. That's on Twitter and LinkedIn, and also Facebook. And for our YouTube, it's Sylvia's Traders Lounge as well.
Yes.
So you can be able to access all the previous webinars that we've done with guests, and also the ones for teaching, the ones that myself, Sylvia, and Dennis have done, including Samuel. I think you were one of them, right? Yeah, so you can access that and then reach out to us for more information.
Yeah. So I think that's it. And any parting shots, final goodbyes. I think that's it. I think that's it. We still, our journey still continues, and we are in the education space, so feel free to reach out to us. And until next time, we'll catch you guys on our social media handles and on the website, on the phone calls.
Yes.
Yeah.
So continue to stay safe, and I would urge you to also get, other than sanitize and wear a mask, go get that vaccine and stop getting into conspiracy theories.
Yeah.
Just go get safe, protect your families, just get that vaccine.
All right.
Do yourself and everyone around you a favor.
Yeah. All right. Cheers, guys. Next lessons, look out for that on our YouTube channel. We normally have weekly interviews, weekly podcast, and it's a wrap. Thank you, guys.